Good day all, and welcome to HLB's International Tax Webinar. The title is Tax Implications of a No-Deal Brexit. It is November 24th, the year 2020, and what a year it has been. Not only are we dealing with COVID and the implications of businesses, the implication on movement around the globe, and the social impact it's had. We're also dealing with the US elections. And finally, the topic of today is Brexit. Brexit and how that impacts businesses and individually people moving around the world. So stay tuned. We have a great panel to take us through these updates. But just a reminder, you are attending a Brexit conference webinar. It's not a Trexit conference. And if you don't know, Trexit is a Trump exit from the White House. So we are having a more interesting topic right now. And let's introduce the panel of Mark Butler from Ireland. Say hello, Mark. Nick Farmer from the UK, the heat of the source of Brexit. Christian Jandor from Germany, Pascal Schirder from the Netherlands, and Dave Springsteen here to guide you through this presentation. So let's move forward to the next slide and get into the mandate from you guys to make this interactive, to answer your questions. Please use the Q&A box and we'll get to your questions the best we can. So again, the Q&A box. So what are we going to be talking about today? Well, there's four broad areas that we will talk about and share ideas and concerns. But before I do that, by show of hands to see what kind of biases we have on the panel, who thinks there's going to be a deal by year end? The UK and Ireland. So Chris and Pascal, you don't think there's going to be a deal by year end? Interesting. Okay. So the agenda will be an update on the negotiations. What are some of the sticking points that we're facing right now in the Brexit? Then we'll roll into the tax implications for individuals and businesses. And the third topic generally will be the trade agreements, what's actually happening between countries and dealing with the UK directly or dealing with the UK indirectly. And then some final comments about what a deal could really make. So moving on to our first broad area. We're all concerned, we're watching the news, there's a lot of competing information out there. And maybe Nick, you can take us through where do we stand right now with the negotiations?
Yeah, I mean, we're trying to piece this together, and thanks for the introduction, Dave. Just trying to really understand what's coming out from the media as to how these negotiations are going. I think in recent days, there's certainly been much more positive commentary about the discussions. And, we're hearing to some extent that perhaps 95% of the trade deal has been negotiated and are now sort of working on a line-by-line basis. I mean, we're dealing with the EU, right? This was never going to happen overnight. A lot of negotiations with the EU go down to the wire. So I think you can expect this to run a little bit further. There are sticking points. There's nothing that seems insurmountable. There's the emotive kind of fishing. There's the kind of take back control issues of governance and state aid. The UK government needs to show some success in these negotiations. It can't allow itself just to be steamrolled as it's positioned itself on actually, bringing back control to the UK to make, its own decisions. So these sort of issues are always going to sit there as sort of, things that need to be agreed on. And the EU, we know they've got a drawer full of ways of sort of putting these things into writing that to some extent means that they can come back to it at a later date. So I'm pretty hopeful. And Dave, you've talked about the US, and I think that is a relevant factor here. I think, with Trump sort of going from the White House, the Biden administration coming in, looking at a more positive sort of global outlook. We know they want to talk to the EU and the UK. I think the EU and UK want to do a deal here. The UK talks about being happy to do an Australia deal, but nobody would be ever happy with that. I mean, Australia's on the other side of the world and they're not happy with their deal. So, the UK aren't going to be happy with an Australia deal here. So I think the energy is there from both sides to come up with a deal. I'm not saying it's going to necessarily be a comprehensive deal. These trade deals come in all sort of shapes and sizes, and you could have quite a skinny deal here which may just deal with tariffs. I mean, that's the big issue, right? Are you going to pay customs duties on the movement of goods cross-border? We know there's a hard border. That's an absolute certainty. We're leaving the customs union. So this isn't about keeping the status quo. This is about trying to make trade as seamless as possible, but it's never going to be seamless because there's a hard border. There's going to be customs procedures in place, and UK businesses are now waking up to that. There's other important aspects that have got to be thought about here. Product standards, safety regulations, data. There's a lot of issues that go into a free trade agreement.
Right.
So we're hopeful. I think it would make a big difference if we do have a deal, but it's not going to take away a lot of the bureaucracy that is going to happen regardless of whether it's a deal or no deal here. So take on from the UK, I think, is that the media seem to be suggesting, and the kind of you see this factored in perhaps through the exchange rate movements we're seeing at the moment, that sterling has strengthened a little bit on the positive sort of mood music coming out from the media. So we're hopeful, I think, that something will be put in place before the end of the year. So the question is, what will that look like?
So curious, why did fishing find its way to this slide? Why is that key?
It was, when they were, actually going back to 2016. So when they were actually looking at the referendum, that was an issue that was in play then, and they got a lot of support from the fishing communities to leave the EU, to be able to fish in our own waters freely. And of course, once you've kind of you've actually set out your stall on that basis, you've got to try and get as far as possible to being able to show that that's what people have got. So I think it's an emotive one, that. It's not a big economic one, but it's definitely an emotive one.
Right. I don't know if any of our panelists have any comments on their views on this negotiation that's going on, but Mark, any thoughts?
Yeah, just from the Irish side and our media, it's showing much the same as well, that it's 95% approved and there's that 5% left. And we're still being told, listen, we need to prepare for a no deal, but that the hope is that what's been talked about at the moment now is a bare bones trade agreement, which sort of dovetails back to what Nick said around that it might just be around tariffs. Although we don't expect the period to be extended, there might be some type of a period, changeover period, if you like, post the 1st of Jan. But even this morning, what's hit our headline this morning, and Nick referred to hard borders, and that's what Brexit will bring. And just the Northern Ireland Protocol, something came up this morning that just around food, and this is into the specifics of it, when people start thinking about it, that the Food Safety Authority will be both Southern Ireland and Northern Ireland will be part of the EU, if you like, for those type of agreements. The FSA don't allow the import of non-frozen processed meat products, the likes of sausages and mince products, etc. So essentially, the Northern Ireland supermarkets won't be able to import those type of products from Britain in order to stock supermarket shelves at the moment. Plus, there's a whole lot of Irish business that exports those type of products into the UK. So there's those types of real specifics that I would say behind the scenes are big negotiation points, because they have economic impacts.
Are you saying there will be no more Guinness in the UK?
No, I don't think that falls under it.
Well, I know there was discussions early on that some countries may benefit from the Brexit being either a financial center or not. Can anybody comment on the views now of either a soft landing or a hard deal or whatever you want to call it?
I think if you're talking about financial services, a trade deal is very unlikely to cover services. They don't invariably go too far into services. Once the UK is outside the EU, it's going to be very hard to provide financial services from outside the border. And so we've already seen financial service businesses reorganize their operations, set themselves up in the EU. We've taken companies through this process that they know that if they're going to need to deal with EU customers, that's going to have to be done from within the border, not outside the border. So, we're financial services, I think, will be something which they've already made that choice to reorganize their affairs. They're not sitting on the fence. They haven't waited. As soon as the referendum result came along in 2016, they could be pretty sure that was going to be the case. But the UK is 80% a service sector economy. They're exporting almost half of their exports to the EU are services, not goods. The EU doesn't export anywhere near the amount of services back to the UK, so it was never going to be in the EU's benefit to go too far down the services negotiation. So, yeah, I think the UK financial services will have a freer hand globally, but with the EU, it's likely to have to be conducted within the borders rather than from outside.
Good. It is quite amazing when you look at this globally between the US elections, Brexit, and COVID, how strong the economies are, the markets are, but we see all this hurt that's going around. So I guess to stay tuned and ongoing developments with these negotiations. So why don't we move on to something very dear to most of us, and it's taxes, the tax implications that will impact businesses, maybe the implications on individuals, and maybe we could start with VAT first. And Pascal, maybe you can kind of walk us through what you're seeing as the implications on VAT.
Yes, of course. I think VAT is the most visible aspect, the free movement of goods versus people and capital, one of the three pillars of the European Union. VAT is with customs is the most visible one. Everybody can have some understanding of what is happening there. When the UK will leave the EU, VAT will no longer be part of, or the UK will no longer be part of the VAT system of Europe. So we will there also have a hard border, which in effect means that export-import of goods or services will be treated differently from a VAT perspective. That's something that we see clients moving on, whether they are based in the UK and providing the services of goods to the European Union, or the other way around, Dutch clients who are operating in the UK. We see preparations on that respect, so that they know that their billing is changing, the flow of goods is changing, possibly. And we are dealing after Brexit with a VAT out of scope, so to speak. So that will have an impact on business, but especially on the compliance side, together with customs.
So from a U.S. standpoint, we would need, if we're selling into the EU, into the UK, changing our invoicing and registration and sourcing is what you're saying.
Yes. MOS reporting is one part. Mark will speak on that later, but on the VAT perspective, if you bring goods into the European Union, now you have a choice which country you choose. UK is one of those choices. But after Brexit, that of course is no longer the case. So if you want to bring goods into the European Union, you have to go somewhere else. It's not logically anymore to go through to the UK. So we see clients anticipating on that one.
Okay, thanks. Interesting. I heard a quote from a very famous person on this panel a while ago about these borders that are going to go up and the slowness of transport that might occur. And so any fresh fruit, fresh flowers, anything like that, the way you ship around may change quite a bit along with the VAT reporting. So, Mark, any comments, or Nick, about the VAT?
Even just to that specific point, because again, from an Irish perspective, that's very relevant, because even for Irish businesses who are trading with other EU businesses, use the land bridge through the UK. So a lot of the huge amount of the goods and most of the goods travel through the UK. I was speaking to one client specifically recently who ships or by road to mainland Europe on a weekly basis to the same place, the same goods, and one truck can go twice a week at the moment. So they go out on a Saturday, back and back out again. They get 2 loads out and back. And looking at the planning and looking at the extra customs and the time that's going to be involved, and this is even if there is a deal, that will be down to one load. So it'll add about 20 hours to the journey. So even if they decide to go by boat into France and up, it still adds a bit. So that's additional costs that businesses directly of Brexit that have to be planned for.
I think there's some things to certainly add from a UK perspective. The UK is obviously designing its own rules and regulations here once it leaves the EU. So we're going to have our own global tariff on custom duties, and if you look at that global tariff, somewhere between 70 and 85% of goods coming into the UK will not have any custom duties on them. Anything which was down below 2% has been taken to 0. So the global tariff is typically going to be slightly lower than the EU's standard tariff. There's big issues here, tariffs if you go into, you're exporting into the EU from outside. We know that cars are about 10%, dairy is at 35%, and this is why obviously a deal is very important. But the UK is designing its own system on tariffs. A lot of goods won't have tariffs. If there's no deal, then probably about half the goods coming from the EU will have tariffs attached to them. To try and smooth this process, the UK are introducing their system on a staggered basis. So from the 1st of January, if you've got non-controlled goods coming into the UK, then you can actually pay the custom duties, not at the border, but the custom duties can be dealt with over the next 6-month period. So it takes away some of the potential delay that could occur at the border there. VAT accounting is going to be postponed in terms of, rather than import VAT being paid at the time of importation, it's going to go onto the tax return. So very like the Netherlands system, that it's really deferred VAT accounting through the next VAT return. So there's certainly some emphasis to try and keep things moving from the UK side of things. Every British business has been issued with a GB URI number, for the importation of goods. The government was aware that not all businesses were getting themselves set up to be able to import goods from the EU, so they've forced the businesses' hands and just issued them with that number. So I mean, there's certainly I guess, concern that some of our ports are going to really struggle to cope with the excess bureaucracy. Customs declarations are forecast to go up somewhere from about to about 250,000 here. It's going to increase dramatically from where we are now. So we've got a lot of kind of bandwidth to build to deal with this. So I think there is a concern, but we're trying to do our bit to keep goods flowing from the UK side. So I think those are our issues, customs and VATs, they're the big ones. Other issues that you've kind of got in the mix are things to do with corporation tax, income taxes, but a lot of that's being dealt with through the treaties anyway.
Right.
So, those matters shouldn't sort of change for business. You're dealing on a sort of a treaty basis. So from a tax point of view, managing the customs and the VAT is really the big one for businesses, I would say.
Okay, good.
On VAT, what we have seen in the last few months is that UK businesses are setting up companies so to have access to the Dutch VAT system, to have access on this deferred tax payment within the tax return. And so we'll be setting up some dormant companies for that purpose only, because nobody really knows what is going to happen after the 1st of January. So I think customs is the most, gives the most uncertainty what's going to happen. VAT as such is clear how that will have to be dealt with. The only thing is that companies really sometimes don't have an idea of how they're going to structure the flow of goods, because now the Dutch VAT system is beneficial, but do they actually want to set up a company in the Netherlands? Does that make business sense? Or is there market, for instance, in Germany? Should they set up a German company? So that are the insecurities which can't be solved until Brexit, really.
Interesting. So maybe we can move ahead from a German perspective. And Chris, can you talk to and inform us what this Brexit Tax Accompanying Act is all about?
Yeah, the Brexit Tax Accompanying Act is a German legislation with the purpose to protect German companies that enjoy EU tax benefits in relation to UK business structures, let's say. But before I talk about this specific act, I would like to point out the importance of the EU law, the impact of EU law to the tax world. And we cannot overestimate the importance. Let's mention some directives which had, in practical terms, enormous effect on the possibilities how to structure international business, how to structure international groups. For example, the Arbitration Convention that gives a claim to a taxpayer to avoid double taxation, or the Merger Directive, which grants participation exemptions for business, the Parent Subsidiary Directive, which grants exemptions of withholding tax on dividends, and interest royalty directive with exemption on withholding tax on interest and royalties. So these are rules which will no longer apply in relation to the UK. And from the perspective of a tax lawyer, this will bring you into a new world. And yeah, we are able to deal with this from a legal perspective, of course, because there is already a world outside the EU where these rules are not applicable. But we have to see that this is a bunch of rules which was very advantageous for the taxpayer. And now UK will give up these rules. I can add some more examples. We shouldn't forget the jurisdiction of the European Court of Justice on the fundamental freedoms, the freedom of establishment, the free movement of persons, services, capital. which prohibits the discrimination and restrictions. These are general rules which had enormous impact on certain tax fields. For example, the national exit tax rules are very much restricted by the freedom of establishment and freedom of movement. Or the cross-border loss recognition. It was born by the European Court of Justice, beginning in the Marks and Spencer space, actually a UK case in 25, and there was a chain of judgment developing this aspect more and more. These fields will no longer more applicable in relation to the UK, and this will influence the tax structure between the European Union, in my case for Germany, with British companies. Now one word to the Brexit Tax Accompanying Act, which was enacted in March 2019, with the expectation that the politicians will not be able to conclude a deal exit, and it is designed to apply in the case of a no-deal exit. And the core objective is to preserve the tax status of German companies that benefited from the EU tax privileges in relation to transaction with UK companies. And I give you some examples on that. If you transfer a good from a German company to a UK permanent establishment, for example, I think it's more or less in all jurisdictions the same, that there is a general tax recognition rule. If a good moves outside, then you trigger the unrecognized appreciations, what we call hidden reserves. And there is a rule under the EU law that says, okay, there is a deferred tax in such a case. You do not have to pay it all at once, but you can pay it, let's say, on a deferred basis. What happens in the case of Brexit? Then the reason for this privilege is off, and one can say, okay, this could be a taxable event. So the Brexit Accompanying Act, Brexit Tax Accompanying Act, avoids this. It says more or less that in all instances where German companies enjoyed specific EU privileges, the Brexit is not a taxable event to tax because the privilege or the reason for the privilege is so. This deals with the transition of goods from, as I said before, from a company to a permanent establishment, but it's also applicable in cases where we had, for example, a tax-neutral merger from of a German company into a UK company or vice versa. And then the law says, okay, if now the condition for the tax neutrality is off because of the Brexit, okay, we don't care, we protect the transaction, and this is no taxable event. So this is, in general words, the objective of this act. Let's say you can say it's a protection act for German companies. I think it's a very practical approach, and it will be very effective if it turns out that we have a no-deal Brexit.
Good, good.
So far to this point.
Good. Thanks for that oversight. More to come, I'm sure, and the impact to come. You know, during the COVID period, a lot of us have seen businesses restructure the sourcing of their goods and where their people are providing services from, logistics and backup logistics, and this kind of bring it home kind of attitude. And so businesses have gone through a restructuring. Are we in a point of a perfect storm that, you know, the restructuring because of the U.S. elections and the Brexit? Do we have to go back to the drawing board again with clients and businesses? Anybody want to comment on that?
From a UK perspective, we've certainly seen business reorganize their supply chain. You know, it picks up on the point that Pascal made in relation to, you know, the flow of goods and why would you necessarily import them to the UK and then need to sort of export them into the EU and potentially, you know, incur additional cost when you could take them directly into the EU. So, you know, we've done a lot of work actually with both Mark and Pascal's firm on restructuring and looking at where companies should set themselves up in the EU. There's no one answer for all businesses. The Netherlands obviously works well because it's in mainland Europe. It's a key port for taking goods in. So, you know, we've looked at how clients set themselves up there, how they deal with getting themselves registered, if they need local entities. You know, Pascal mentioned about these zombie companies that are sort of set up there waiting to be activated if needs be. You know, so clients are looking at that, and you know, there's Ireland as well has got some key advantages associated with it for UK companies that are wanting to have somewhere set up in Europe. Just one point that Chris made, which I think is a really strong point for companies, is about the UK losing access to these EU directives. A lot of the structuring here did involve those EU directives, particularly on the flow of funds. So where you're talking about dividends, interest, royalties moving around, and the fact that you know, once we move outside or once we end the transition period, you know, those directives won't be in play. We'll be looking at treaty rates, and you know, those treaty rates won't always go to zero. So if you look at the UK-Germany treaty, and Chris, you can just comment on this, I guess, UK-Germany treaty has got a 5% withholding tax rate on dividends. At the moment, you could pay a dividend up from a German company to a UK company, no withholding tax. So, you know, after the end of the year, that can be a true cost to business. So, you know, business is looking at how they move funds, what's tax efficient. You know, you could flow a similar dividend out of the Netherlands or Ireland without withholding tax. So, you know, we might see a little bit more around treaty kind of arrangements and being, you know, particular about where you are moving funds to and from. So restructuring has been a big part, and I don't think it will stop, you know, at the end of this year. I think, you know, a lot of these issues will come to the surface after we've left the EU, and we'll see reorganisations continue to take place, you know, into next year as well, I'm sure.
Interesting insight.
Yeah, I think from a restructuring perspective, it hasn't really started, because even now there's only businesses really looking at how Brexit is going to impact them. And I think, you know, what I'm seeing from a UK perspective is that a lot of that restructuring is we need an EU entity, or we need an EU presence outside the UK. And then on the other side, for people doing a lot of business in the UK, it's how do we structure? Do we put a new company in the group? How does that work? And even if to use an example, and I know triangulation, getting back to VAT a little bit, but that simplification tool is really powerful at the moment from a VAT perspective. And I suppose with Pascal, if we use the example of if you have a Dutch company selling tulips to an Irish supermarket, but it's selling it through an agent in the UK, that's all zero rated for VAT at the moment. So the sale to the UK company and the sale to the Irish company, and the goods are delivered directly, say, from the Netherlands to Ireland. But because it's an EU simplification tool, triangulation won't apply to the UK company post the 1st of Jan. So that UK company has to find another solution to that, how they continue with keeping the VAT simple. But also in the future, that EU companies have to be thinking about, well, who are they buying from, and if they're buying from a UK entity, can't zero rate their supplies using a UK VAT number. So there's all of those, and I think as that starts to really affect trade post the 1st of Jan, that's when we'll see a lot more business restructuring.
Okay. This term sitting on the screen here, loss reporting.
Oh yeah, okay. I'm happy to take that as well. It's it's another VAT simplification tool, and it's mini one-stop shop is what it applies to. And I think it's there since 2015, but really it's for non-EU businesses who are providing telecommunications, broadcasting, or e-services in the EU. So it's things like selling software updates or perhaps online training. So say if we pick a US company, Dave, they can register in one EU country and do a MOS return for all of their sales around the EU, and just do one return in the EU country and then that VAT then is distributed around the relevant countries. It's very simple and a much simpler solution than registering for VAT in every country. But you take a lot of companies would pick the UK as their base for that registration, but post 1st of Jan, deal or no deal, that won't work. MOS won't apply in the UK, and it's a really short window, because for companies who need to register post the 1st of Jan can't do it now. They have to wait until the 1st of Jan, and then the first return is due on the 10th of February. So there's a very short period where companies can remain compliant.
Right. Seems to me that a lot of businesses will fall into quicksand and overlook things, and hopefully there's some relief to penalties and interest and the like, late filings. So interesting times for sure. So for the panel, with the tax implications on business, is there one thing we can tell our clients or tell the public about they must do by December 31st?
I think from a UK perspective, there's a lot of information out there, and the government has some very good documentation and tools here. If there's one thing for business, it would be to read the border operating model. This sets out quite clearly, how our new border is going to work, the customs arrangements, the VAT arrangements. It's very difficult to be generalistic about that, and all businesses really need to look at their own circumstances and to understand what it means for them. So I think that's where I would go if I was a business that was trading and flowing goods across the border.
Sure. Information is powerful, it's value, so getting to know what impact Brexit will have on their business is key. And of course, we can chat with you guys. So moving on, unless anybody has any comments on this slide, the business slide, we're good? So why don't we go into the individual slide here and talk about some of the income tax implications, the movement of people, and the lockdown that COVID's creating, and what may happen between COVID lockdowns and Brexit. So I'm going to just throw that up to the panel, and anybody want to grab that and get us started?
Yes, I will kick this one off, Dave, if I may. What we see in the Netherlands is a lot of European citizens living and working in the Netherlands. Within the directives, as mentioned by Christian, we also have a directive of migrant people, which regulates the social security contributions, which system will work and which not. We have the A1 forms, the forms that one country will levy the social security. But this to make sure that migrant workers are not double taxed, either on income tax or on the social security part of it. So that will, after Brexit, also change, of course. There is no arrangement any longer for UK citizens working in the Netherlands or not. So that might lead to double taxation, or at least might lead to some uncertainty on what is about to happen on that one. But specifically on the, I think on the social security part, if you work in one or multiple European countries, that is something that really is benefiting those people, and is making it quite handy to arrange your social security position. This is a part with which we do not hear a lot of on this. Mostly is most attention is going to customs and VAT. What for, at least in the Netherlands, a lot of UK citizens who will be affected on this. For instance, all the wage tax and employment contracts should be reviewed if it's applying on a UK national living in the Netherlands or working in one or more countries. So for very specific cases, UK citizens living in the European Union or working in the European Union and working in other countries as well, this will have some effects which they should pay attention to.
Okay, good.
With regard to this social security aspect, there is an old mutual agreement between the UK and the Netherlands. I believe it's from the 70s. So there's not really something to fall back on, which is modern or which is up to date with current laws and regulations. And I'm sure it applies for other European countries as well. So we're not knowing what the effect will be specifically, but is something to keep in mind.
Okay, good. So Nick,
I think, yeah, just to add to that, and Chris made a point earlier that once we end this transition period, we are losing this free movement of people across border, which has been such a powerful advantage for UK companies to have their staff freely move in and out of the EU to conduct activities. And for any UK businesses, of course, the EU is not one body which is necessarily joined up in all respects. You're dealing with 27 different countries, all who have their own rules and regulations that, if you're going to go and work in that country and got clients there, you may have to get specific permits or visas from that country. So this needs to be dealt with on a country level from an EU perspective. In reverse, and just to give you an example here, we're working with a lot of overseas companies who are very concerned about how they're going to manage projects that they were previously staffing in the UK, where they would have brought in their overseas employees to fulfill those projects. And that's just not going to be possible after the end of this year. There's no free movement of overseas workers into the UK. So if overseas companies are tendering on UK projects and winning them, which we are seeing, and then they've got overseas contractors who they're going to use to fulfill those projects, whether those staff come into the UK to work. And we're doing a lot of consulting with businesses about this movement of employees, how they actually bring staff into the UK. Do they need to set up UK entities, have them as the sponsoring vehicle to arrange for visas for these staff to come in and work in the UK? This right to come and work in the UK after the end of the year is a massive implication for overseas companies that are looking to do business here. And there's some very clear changes that are coming in terms of our immigration rules and the rights for people to actually come and live and work here. And so people need to get to grips with those rules, because that all changes from the 1st of January.
I agree. Talking about individuals, I think the movement of persons is the core aspect. There are, of course, tax implications alongside, but I think the biggest impact is really that you lose the freedom to go without restrictions from a EU country into the UK. So this will have a huge impact, as Nick has already pointed out, and I do not have to repeat this, but this will have a huge impact for the individual, for the companies that set over the individuals, and that's at the end for the UK economy.
And Dave, this is US companies as well, right? This isn't just people from the EU. We've got new rules about immigration for anybody that's coming to work in the UK. So, all overseas companies need to look at how they are going to operate in the UK going forward.
Yeah, new days are coming, that's for sure. Okay, Andre, do we have any questions from the audience participants? And just a reminder, if you have a question for our panel, please post it to the Q&A section. So, Andre, any questions out there?
No questions so far.
Okay, good. So moving on to the next slide, we've kicked around trade agreements and the negotiations that are going on, but maybe this is more from your point of view, Nick, and what you're seeing, some of the highlights and special negotiations going on, if any.
Yeah, it's a really important aspect for the UK, because, for the last 40 or so years, we've sat behind the EU. We've benefited from their trade agreements that they have with countries around the world. There's currently about 38 agreements that they have in place that cover over 70 countries. And once we leave the end of this transition period from the 1st of January, none of those agreements will apply. So the UK has had to look at those arrangements and try and forge its own trade agreements with those countries. It's doing a pretty good job, actually. They concluded the agreement with Canada at the weekend, and that is just a rollover of the existing EU agreement. So that one looks to be going into place. A few weeks ago, they did Japan, and that's not just a rollover, that is actually slightly different. It's got different terms. Business would need to look at that if they're trading with Japan. A big one outside the EU was Switzerland, and that's been agreed, and there's a new trade agreement that will go in place from the 1st of January. So currently, of the existing agreements that the EU has, there's about 14 that the UK has not got these continuity arrangements in place. When you look at those economies, some of them are significant. You're talking about countries like Mexico, Singapore, Egypt, Turkey, Vietnam, some big countries that we so far don't have these agreements in place. So any UK businesses that are trading globally need to really look at these arrangements and see what the UK has negotiated and what the terms of those agreements are, because not only are we looking at the trade agreement with the EU, we're also needing to look at it on a global basis. And of course, Dave, you know, the US is probably somewhere down the line here. You know, whether that's going to be on the table or whether the eyes will turn between the US and the EU, but it's certainly you know, being talked about as a future trade agreement that the UK would want to do.
So, Nick, this is probably an unfair question, but the terms of some of these agreements, are they better terms than pre-Brexit? Or are they, is one country favored over another? Any comment?
Well, the Japan agreement is meant to be slightly better in some respects. For instance, financial services, data, you know, there's slightly better terms there than what was previously agreed under the EU. With Canada, they've agreed to roll over, but to renegotiate and to look for more favourable terms. So the UK is looking to improve on what it had for sure under the EU, but you know, for now, we're just looking to make sure that what we had in place can at least be there from the start of next year.
Good. All right, stay tuned. Some industries will benefit, some will not. Some countries will benefit, some won't. Brave new world we're in. So our final slide is a deal or no deal, kind of a game of chance here. I'm going to throw this up to the panel. Does a deal make a difference for our clients, for businesses? Anybody want to take a closing comment on this?
I think from my perspective, a deal makes a huge difference, and it's really important that a deal happens because anyway, my Irish clients, a lot of them, like Nick referred to tariffs on dairy of 35%, etc. So the clients that, from an Irish perspective that I'm helping restructure or look at what they do in the UK, it's all on the basis that there is a deal, because you know, in short, what they say, if there is no deal, we won't be trading with the UK because it just won't be competitive to be able to do it. So I would think a deal is really important from both sides, both from the UK out and putting goods into the UK.
Pascal, any thoughts on this?
Well, I'm on the same page as Mark. A deal will keep the competitiveness of the businesses in place. That's the biggest uncertainty now. The paperwork is important, but if the business can't survive, we have another problem.
Okay.
No,
Nick, sorry.
Sorry, I was just going to say that, you know, as we've mentioned, deal or no deal, there is a border. You know, there is the need to deal with customs formalities. There are changes in the way that goods are going to flow, but is a deal going to make a difference? Yes, as Mark said, it could be a massive difference on just being able to do business competitively across border. If tariffs come into play, as I said, they're probably on about 50% of the goods coming into the UK from the EU. That would be a massive change, big cost to business. So I don't think it's in anybody's interests to not have a deal here. There are some other areas, you know, tariffs are the big one, and it really depends how far a deal actually goes. I mean, it could be quite sort of light in terms of other areas it covers, but you know, we mentioned at the beginning things about data flowing across border. That's a massive one for the service sector. And at the moment, there's no continuity arrangement, you know, from the EU here. You know, UK data can flow into the EU. We've, you know, had that confirmed, but coming back the other way, that's not necessarily the case. So we'd like to see things like that sort of, you know, agreed. I don't think a deal is going to go as far as services, financial services, as we've said, have already sort of made some changes here. So I expect that a deal will only be the starting point, that they'll come back to it. It won't cover everything. They'll need to go further at a later date. Let's hope that a deal is done, so at least the issue around tariffs can be mitigated as much as possible, so that these businesses that are trading cross-border can hopefully enjoy the way that they're currently trading without this additional cost to doing business.
Okay, good insight. So we're up against our deadline here. I do want to thank the panel, Mark and Chris and Pascal and Nick, for their timely insight. We didn't need any crystal balls here, nor did we need any crazy 8 balls for answers. You guys seem to be on top of everything here. So if our audience has any questions, they can reach out to you directly. But our final slide really says, get in touch, for more insight on businesses and individuals and this cross-border negotiations that are going to go on. Visit HLB global/tax, and there'll be information there. But more importantly, reach out. So thanks again, everyone, and thank you for attending this conference, and stay tuned for more. Good luck, Nick. Thank you all.
Thank you.
This concludes our webinar.